Andrew, good to have you back on the program. So this morning we've got a jobless claims that looks real solid. Industrial production yesterday being followed up by Philly Fed outlook. So this data is now beating pretty sizably to the upside. But you say we're not out of the woods yet in terms of the recessionary risk.
Yeah, good morning, Oliver. And exactly, we think that the data that's coming out now has been declining on a sequential basis month over month and year over year. But the expectations that are coming out from the economists have been so low that we're seeing those positive beats. But like for the initial claims this morning, last month's initial claims number was revised higher. And then I think that that trend will continue down the road as we see more economic reports come out. But yes, on net, we are starting to see some increases based on just kind of the expectation or surveys versus kind of what's coming out right now.
So Andrew, one of the charts I want to jump to is looking at the relationship between jobless claims and the S&P 500, a chart that you brought us that I think is pretty interesting because whenever there are these spikes, you get periods of risk off as we would think about, recession, folks losing jobs, but the bet here is still basically a bet because the trend is still very much in favor of unemployment, going lower and jobless claims staying strong. So how do we know when those wheels turn until the trend really starts to manifest itself?
Yeah, that's a great question. And so what we're looking for right now is to get a lot of clues and evidence from the earnings season that we're getting into right now. And for instance, profit margins for these companies are at all-time highs. And we're starting to see a lot of revisions to the downside for Q3 earnings expectations. We've seen CapEx get lowered. We've seen different business plans get lowered for these companies. And we think the next leg is they're going to start either laying off individuals and stop, with their employment trends, which will start manifesting itself via credit card purchases. So one of the data points we're looking at is, yes, while the consumer has been strong, but they've been strong via credit card debt. And so we think that what will happen is that they're going to be seized up from their financial obligations, and that's going to start raising initial claims higher once that layoff starts manifesting itself in the next 2 to 3 months.
Interesting. So what's the strongest case here for the companies having to actually go and trim down the workforce more? I know we've seen this on an isolated basis for companies that are under a lot of specific pressure, but is it possible that we could sort of have a resurgence or a grind to the side in the economy if some of the big overhangs like the tariff situation slow down a little bit?
Yeah, I think that really if we start seeing those things slow down and we start finding out that there's more, just incremental data that gets a little more positive as we go, we think that companies still are going to be in a little bit of trouble just from really how much they've already hired and the wage gains that we've started seeing that employees demand, and that will just continue to hurt their margin and their pressures.
Let's check out the consumer and the credit side. This is one of the things I know you've been looking at. You just mentioned the potential for the consumer to kind of seize up. For many who've been looking at that as being the kind of rock of the economy, the U.S. consumer right now, what are you looking at here? What's the most damning evidence that maybe people are overextended?
Yeah, so I think right now it is the amount of credit card debt that we saw that the Federal Reserve published last month. It was one of the highest record amounts of credit debt that we've seen in the last 2 years. But the biggest thing for us is the spread between the average interest assessed on credit card debt to the 10-year Treasury yield. It's actually the highest spread that we've seen in the history of the time series. And it's not only just credit card debt. Last month's consumption number was also driven a lot by auto loans, and auto loans themselves have an extremely high interest assessed number. And we think that those are the issues that will start showing the cracks in the system down the road as these individuals get laid off and as these companies aren't able to keep up with these kind of wage gains that we've seen, and that will end up causing that initial crack, we believe.
Andrew, what's interesting is this is happening as the wage component of our employment reports has been pretty solid lately. It hasn't been blowing out to the upside, but for many it's one of the sort of things the Fed has to watch for inflationary impulse because it's been so persistent with the gains that we've seen for wage growth. Does that turn on a dime?
It won't necessarily turn on a dime. That's why we really are watching over the next 2 to 3 months to really see how that manifests in itself. But we do think that that is now at a point that these companies with lower revenue expectations and earning expectations have to contend with. And that's going to really be a hard thing. So either they're going to slash any future employment expectations. We also believe that because the economy is already at full employment and we've started to see a lot of demand for higher wages, that these companies now are at that phase where they're going to have to start making those decisions and say, hey, we can't afford to continue to pay this, and that will continue into that layoff section.
Is there any question more important, Andrew, than what the trade war's role has been within slowing manufacturing data? When you look at the first tariffs that went on China, as you highlight on the chart of global growth, look, we peaked before those tariffs hit, but this is now a question of, okay, look, so maybe there's a cyclical component here, which is, I think, a really important point that a lot of people miss. And that's the chart, guys, if we show it, because it's really interesting. Basically, you've now got a question of, all right, if the trade war does resolve itself, how much of a bounce back do we get? If the trade war wasn't the cause, maybe not a huge bounce back, but I gotta imagine it's at least pressuring or maybe accelerating the slowness to some degree.
Oh, exactly right. And so that's kind of what we think will help give us a positive upswing in the cyclical behavior of our manufacturing data. But just to take a step back, when we last spoke, we talked about the dramatic increase in interest rates, which is really what gave us the first signal of the slowdown that we saw in January of 2018. But really, as you just mentioned, the trade war has exacerbated all of this. So it has continued to put a lot of downside pressure. And we do see a lot of stimulus that has occurred with lower rates that started to kind of show up in October, November of 2018 that give positives for Q1 of 2020, Q2 of 2020. But what could really accelerate the cyclical upswing would be a resolution in the trade war. Unfortunately, I just don't know if we're seeing that right now, because it's the same story that we've always had. It's trade talk is on its way, but then it might get pushed another month or something ends up happening where everyone walks away from the table. And we're just not as optimistic as maybe the market is right now. And I think that we would rather take that defensive and standby approach.
So, Andrew, as we discussed last time, I think one of the other really important questions is, will this be 3 times the, charm for the economy head faking lower as we've seen in this recovery? I mean, it's incredible how many times we've gotten right to the precipice of technical recession or, negative growth and then bounced right back. A lot of the slowness I see and a lot of the downtrends in either the CapEx, employment, business conditions, they're drifting lower but still have not gotten to the lows of 15, 16. So if we've got this potential of trade war even piling on to a natural slowdown, I mean, is it maybe we don't even get to those levels? I mean, is it possible, and how do you as an investment manager kind of hedge the risk here that maybe things won't actually spiral out of control and that this is just another, deep correction along this very long, unprecedented recovery?
Yeah, that's the most important question, we think. Timing a recession is extremely challenging, and some of the data points, as you mentioned, are not at 2015 lows, but we've also seen some data points from decade lows. The OECD came out this morning and slashed global growth forecast. The chart that we have on the screen right now focuses on the New York Fed's manufacturing indice and 6 months ahead for their employment and CapEx expenditures. And yes, while we're not at those lows of 2015, it is still declining on the same time with a market that is extremely rich in valuations. And so investors have to contend with that. We are at a knife's edge to where we do see a lot of positive upswings in the next, at Q1 2020, but there's still a lot of time and a lot of black swan events that could happen since then. So what we've always talked about with our investors for the last 18 months is stay defensive. Go buy those long duration bonds, hold the treasuries, keep cash overweights. As you saw today, the post response from the FOMC meeting in this morning's 10-year treasury yields, they're just moving lower. I think last time or before I got on the show is about 1.74. So the bond market itself is signaling something that's a little different than maybe what the equity market is saying. And in my career, I've always kind of followed the bond market first, as it typically gives a very good leading indicator. And we just keep saying, those defensive names will continue to help outperform. Find those total return sectors and industries and factors that will give you that extra cushion. In fact, the last time we spoke, August was just a trade range month, and the only best performing sector was the consumer staples and the utilities for the month of August for the total return aspect that you got out of that. So we tell investors, just stay patient, let the data kind of go through its cycle. We see positives coming in the next 6 months, but be defensive.